it. Point number two, Gary, PCE, we're talking personal consumption expenditures. PCE accelerates a familiar refrain is coming is point and thing number two.
Yeah, so let's give people a little background on this. The PCE stands for, as you said, Rob, the Personal Consumption Expenditures Index. That's the preferred inflation measure of the Federal Reserve. And you can ask them the reasons for that, but I think the reason is because the CPI, the Consumer Price Index, which is the item that most people, that's the index that most people look at as the proper measure of inflation, that's really a fixed basket. They do play around with it every couple of years, but it's more like, well, this category is this weighting, this category is this weighting, and they, track prices, then adjust it. And they always adjust it in ways that make inflation seem to be less than it is, which is another reason people don't trust it. The PCE is more closely tied to what consumers actually buy, what they spend, where they're putting their money. And so it's maybe a better measure of inflation as experienced by the consumer. And so here's what we got this month. The PCE was up 2.4%. The core PCE, that's the index, the PCE that excludes food and energy, was up 2.8%. So, you could say, hey, that's great. That's lower than it was before. We're down below 3%. We're approaching the 2% target, which I will continually insist is still 2% too high. It should be 0. The Fed's official mandate is stable prices, not 2% of theft per year, but whatever. But here's where the numbers get a little wonky. Rob, I'm going to read this to you. Sometimes people like to look at the month over month change. And the change in the PCE for the prior 3 months had been 0, 0, and 0.1%. And then all of a sudden it was 0.3% this month. The core PCE was spent 3 months between 0.1 and 0.2%, and all of a sudden it's up 0.4%, right? So these indexes are accelerating. Now, for a lot of people, that might not seem like much. Like, do we care about a 0.3, 0.4? Like, it's like saying, hey, this thing that costs $100, okay, well, it's another 30 cents. Do we care? Well, here's why you care. A 0.4% increase annualizes to 4.9%. That's 2.5 times the target. And so what we're getting here is acceleration. And to make things even worse, most of the high inflation right now is in services, and that's the part of the index that's very hard for the Federal Reserve to address. And we've got a tight labor market, so there are concerns that, oh no, everybody was saying the Fed has this under control and should lower rates. They may not have it under control.
You talk about risk that isn't priced into these current indexes, Gary, a little bit. As an investor, just personally, I mean, is there anything that we need to be doing to counteract that or to be ready for that risk once it is actually priced into these indexes, especially saying what you're saying to me right now in terms of the spike that we saw just over these last period?
Yeah, so let's talk about that for a second. What we saw at the beginning of 2022 and for much of that year was the market plummeted. It went down roughly 30%, depending on which index you're looking at. And the reason for that is because the Federal Reserve was raising interest rates. Okay, well, we understand that. You have a higher discount rate, and so the value of future cash flows or future dividends from the companies that you own is lower on a present value basis. And where we really saw stocks getting hammered was in the technology sector, because high growth companies where you're projecting a lot of future growth, they're basically high duration assets. And that's just a fancy way of saying a lot of their cash flow is going to come in future years. Well, as you apply a higher discount rate to that, the present value of those cash flows gets really hammered. And so we saw the tech stocks get crushed. And one of the reasons why stocks started to recover at the end of 2022 and through all of 2023 were expectations that the Federal Reserve was about to pivot and start to lower interest rates. Okay, fair enough. That sounds fine. But we were rolling into December last year, And people thought the first Federal Reserve rate decrease would take place in January. And if it wasn't January, it was going to be March. And we were going to get 6 decreases this year. By the way, these people were all saying the same thing last year, and they were wrong all of last year, right? These same people, all of 2023, were saying you're going to see the Federal Reserve pivot and reduce rates. That didn't happen. Now, they were expecting the first rate decrease to happen in January. That didn't happen. They pushed out to March. After some of the recent events we've had, which we've been talking about in the 5 things, now people are saying, okay, well, maybe we get the first rate decrease in June, and instead of 6, we get 3. And again, what's the title of this one? Of this version of the 5 things? It is everyone's wrong and should admit it issue. And instead of admitting it, these people, they just keep, it's sort of like saying, the aliens are coming to take us away on Monday. All right, well, it's a Tuesday, Wednesday. At some point, just admit that this isn't happening. But what's happened is, even though these expectations for rate decreases have been pushed back and lowered, and again, people thought it would happen in 2023, didn't. They thought it would happen in January, didn't. Now they're halfway through 2024. All right, but we now have market indexes at all-time highs, with Powell making it crystal clear higher for longer. And Rob, I don't know if you saw, but this week there was even talk that the Federal Reserve could increase rates again. Now, I don't think that's about to happen, but we've gone from, why haven't they reduced rates? 6 rate reductions are coming. Okay, 3 rate reductions are coming. Oh, well, maybe they'll increase rates. But while this is happening, the market is making all-time highs. Now, part of that is NVIDIA. Okay, great. And a couple of other, mega cap tech stocks that, in fairness, have been performing really well on a fundamental basis. But, you've got higher for longer. You have increasing inflation here if you're looking at the short-term PCE. And, maybe the market hasn't incorporated that yet. People might want to acknowledge the macro environment, and it's not priced in at the moment.
Great analysis there, Gary. Appreciate that.